Yeah, day 16. So we'll continue with the Indian perspective where we last left off. Um, Here we first briefly present the key features of some of the money market instruments available in India. We then briefly discuss the dated securities and securitization market in India. Then we briefly show how Sensex is calculated using the free float methodology. We conclude by briefly discussing about the different bond market indices that the National Stock Exchange NSE calculates. Treasury bills. At present, the Government of India issues three types of treasury bills, namely 91 days, 182 days, and 364 days. They are issued at a discount and redeemed at par. While the 91-day bills are auctioned every Wednesday, the 182-day and 364-day bills are auctioned every alternative week on Wednesdays. Certificate of deposit. A certificate of deposit or CD is a time deposit with a bank. As of now, the regional rural banks and cooperative banks are not allowed to issue CDs in India. As per RBI guidelines, CDs are issued at a discount to face value. CDs issued in denominations of rupees 1 lakh and in multiples of rupees 1 lakh thereafter maturity value are negotiable. That is, they can be sold to another investor if the owner needs cash before its maturity date. CDs are issued with maturity period ranging between 7 days and 1 year. Short-term CDs are highly marketable, although the market significantly thins out for maturities of 3 months or more. The financial institutions can issue CDs with maturity period ranging between 1 year and 3 years. Commercial paper. Highly rated companies in India having minimum net worth of 4 crores rupees having a minimum rating of A2 and above as per the rating symbol prescribed by SEBI and meeting other criteria specified by the RBI can issue in private placement their own short-term unsecured debt notes. These notes are called commercial papers, CPs. Now, financial institutions, apart from primary dealers, can also raise short-term funds by issuing CPs. CP commercial paper maturities range between 7 days and 1 year. CPs are issued in denominations of rupees 5 lakhs or multiples thereof. Like the CDs, CPs are also issued at a discount to the face value. In India, CPs attract stamp duty. However, secondary market transactions in CPs do not attract any stamp duty. Of late, the money market mutual funds in India have become large players in the secondary market for CPs. Repos and reverse repos. One can use repurchase agreements, also called repos, as a form of short-term, usually overnight borrowing. The minimum period for repo transaction was 3 days at one point of time. Now it has been brought down to 1 day. In a repo transaction, uh, one transfers government securities. Now, state government securities and bonds issued by public sector undertakings and the private corporate sector, provided they are in a demat form, are eligible for repo transaction to an investor on an usually overnight basis, with an agreement to buy back those securities after the repo period at a slightly higher price. The increase in price is the interest for the repo period, adjusted for the coupon. A reverse repo is the mirror image of a repo. Here, securities are purchased with a commitment to sell them back after the repo period. Call money market. Call money market refers to the market for short-term funds with maturity period ranging between 1 day and 14 days. Technically, if the period of lending exceeds 1 day, 2 days to 14 days, it is called notice money and not call money. In India, banks and primary dealers are allowed to both borrow and lend money in the call money market. However, financial institutions, mutual funds in 1997, all SEBI registered mutual funds were also allowed to lend money in the call market, and a select group of corporates are allowed to lend money in the call money market. From a different midterm reviews of monetary and credit policy, the RBI is sending clear signal that it wants to convert the call market in India into a pure interbank call money market. The non-bank entitles are encouraged to participate in the repo market now. Government securities, GSECs. The government of India borrows funds in large part by selling dated government securities. The GSEC maturities range up to 30 years. The subscriptions for GSECs can be minimum amount of rupees 10,000 and in multiples of rupees 10,000 thereafter. The face value of GSEC is rupees 100. GSECs make semi-annual payments like their counterparts in the US. The yield to maturity reported in the financial pages is calculated by determining the semi-annual yield and then doubling it rather than compounding it for two half-year periods. This use of a simple interest technique to annualize means that the yield is quoted on an annual percentage APR basis rather than as an effective annual yield. The APR method in this context is also called the bond equivalent yield. Securitization in India. The first securitization deal took place in India in 1991 when Citibank raised 16 crores for GIC mutual fund by securitizing some of its auto loans. However, most of the securitization deals in India took place after 1999. There are instances of securitizing auto loans, construction equipment and mortgage-backed securities, receivables, habit, and credit card receivables in India. Most of the securitized products come with credit enhancement and liquidity support, and hence get AAA SO rating, despite lower rating of some of its originators. In fact, India, not a single securitization issue, hence has been downgraded in the last 10 years. The Indian Railways Finance Corporation (IRFC) completed India's first securitization of sovereign lease receivables of rupees 196 crores in 2005. Citibank has played a major role in developing, structuring, and arranging the non-residential mortgage-backed securities (RMBS) securitization in India. The Government of India, through its National Housing and Habitat Policy in 1998, announced a major policy initiative required to support mortgage-backed securitization in India. The National Housing Bank of India (NHB), a subsidiary of the Reserve Bank of India, was asked to play a lead role in the development of MBS market in India. NHB has so far launched 10 issues of RMBS with a total loan size of 665 crores. The investors in all these securities have been institutional investors. So far, no secondary market trading in these securities has begun. NHB plans to start the secondary market in these securities, where it will also play the role of a market maker. Computation of Sensex. Sensex is also a value-weighted index where the market capitalization of each stock is multiplied with what is called a free float factor to arrive at a modified market capitalization of stocks. Final weight of 30 stocks included in the index are determined based on the modified market cap. Figure 1.1 shows the calculations. Let's explain the computation of Nifty by using the examples of Axis Bank. The market cap of Axis Bank as on December 18, 2018 was rupees 1590 was rupees 1.590282 million. However, that's a very weird notation, but yeah. However, the free float adjustment factor is 0.7. This implies that about 30% of the stocks of Axis Bank are with promoters of the company. The free float of a company is determined as per the format of shareholding pattern stipulated by SEBI and incorporated in clause 35 of the listing agreement. Here, the term promoter includes Indian promoters, foreign promoters, and persons acting in concert. The modified market cap or the free float market cap of Axis Bank is therefore determined by multiplying 0.7 with the total market cap of Axis Bank. Okay. Free float. Okay, got it. So free float market cap of Axis Bank equals to that number, 1590282 billion rupees times 0.7 equals to 1113197 million rupees. This combined free float market cap of all 50 stocks included in Nifty is 447,59599 million rupees, as against a total market cap of rupees 79,022,067 million. The final weight of Axis Bank in Nifty is determined by dividing the free float market cap of Axis Bank with the combined free float market cap of all 50 stocks. Weight of Axis Bank in Nifty equals to rupees 113197 million by 447,59599 million, which is equal to 51%. That's a lot. Insane. But yeah, so okay. That doesn't make any sense. 51%. How can it be 51%? What? Oh, market cap. Yeah, it's not 51%. It can't be 51%. It's not possible. Doesn't make any sense, but like, yeah. Okay. Yeah, I don't. This doesn't make any sense. Might be how is that 51%? Like, what? That might be an error, actually. Yeah, 100%. Because it's 333. Yeah, it's not 51 million. It's 51%. It's like probably 5%. I think they missed a dot somewhere. Let me actually calculate the actual percentage. So if we go 1113 divided by 44759 times 100. So it's actually 2.48%, not 51%. So this has to be wrong. 2.48%, not 51%. This is wrong. How can it be 51%? That doesn't make any sense. But yeah, okay. So yeah, okay. Bond market indices in India. As of now, NSE provides 3 types of indexes, namely duration-based indices, money market indices, and maturity-based indices. The base date of the index is September 3rd, 2001, and the base value is 1000. Okay. Oh, we're done with this chapter. That's crazy. But yeah, that was a pretty abrupt end, I guess. There's no like conclusion or anything. They just gave a couple of tables here. So yeah, I think that's a typo. 100%. It can't be 51%. That doesn't make any sense. But yeah, okay, it's okay. So yeah. So adjustment factor is basically the percentage of shares that are actually not owned by the home base of the company, so to speak. So yeah, summary. Let's just go over the summary one time, just to remind ourselves of what we covered in this chapter, chapter 2. Summary is money market securities are very short-term debt obligations. They are usually highly marketable and relatively low credit risk. Their low maturities and low credit risk ensure minimal capital gains or losses. These securities trade in large denominations, but they may be purchased indirectly through money market funds. Much of US government borrowing is in the form of treasury bonds and notes. These are coupon paying bonds, usually issued at or near par value. Treasury notes and bonds are similar in design to coupon paying corporate bonds. Municipal bonds are distinguished largely by their tax exempt status. Interest payment but not capital gains on these securities are exempt from federal income taxes. The equivalent taxable yield offered by a municipal bond equals R muni 1 minus T, where R muni is the municipal bond yield and T is the investor's tax bracket. Mortgage pass-through securities are pools of mortgages sold in one package. Owners of pass-throughs receive the principal and interest payments made by the borrowers. The originator that issued the mortgage merely services it and passes through the payments to the purchasers of the mortgage. A federal agency may guarantee the payments of the interest and principal on the mortgages pooled through into its pass-through securities, but these guarantees are absent in private label pass-throughs. Common stock is an ownership share in a corporation. Each share entitles its owner to one vote on the matters of corporate governance and to a prorated share of the dividends paid to its shareholders. Stock or equity owners are the residual claimants on the income earned by a firm. Preferred stock usually pays fixed dividends for the life of the firm. It is a perpetuity. A firm's failure to pay the dividend due on a preferred stock, however, does not precipitate corporate bankruptcy. Instead, unpaid dividends simply accumulate. Variants of preferred stock include convertible and adjustable rate issues. Many many stock market indexes measure the performance of overall market. The Dow Jones averages, the oldest and best known indicators, are price weighted indexes. Today, many broad based market value weighted indexes are computed daily. These include the Standard & Poor's 500 stock index, the NYC index, the Nasdaq index, and the Wilshire 5000 index, and the indexes of many non-US stock markets. A call option is the right to purchase an asset at a stipulated exercise price on or before an expiration date. A put option is the right to sell an asset at some exercise price. Calls increase in value while puts decrease in value as the price of the underlying asset increases. A futures contract is an obligation to buy or sell an asset at a stipulated futures price on a maturity date. The long position, which commits to purchasing, gains if asset value increases, while the short position, which commits to delivering, loses. Key terms: money market, asset. So we don't have to go over the key terms. It's okay. Key equations: equivalent taxable yield, R muni by 1 minus tax rate, where R muni is the rate on tax-free municipal debt. So yeah, cutoff tax rate for indifference to taxable versus tax-free bonds is 1 minus R muni by R taxable. So that was that, and that's gonna be it for today. I'll start with the problem sets tomorrow, and it'll take us some time to maybe 2 videos or 3 videos depending on the length. But yeah, then we'll be done with chapter 2, and then finally we will start chapter 3, which is which I've never done before. So till chapter 2, I had like gone through it and I've done the questions and the Google Docs and everything, but chapter 3 is where I've like never set foot in, basically. And this is where I like lost my track and whatever momentum I had in reading this book. So hopefully, and at this point I'm very consistent with the videos and I'm liking it. But yeah, we're gonna finish the problem sets for the second chapter in like 2 videos, so like 2 days maybe. And then we're gonna start the third chapter, which is how securities are traded. So yeah, fun stuff. Thanks.